All right, it is time for the word on Wall Street. Top investors watching your money this morning. Joining me now, Blank Schein Wealth Management's Robert Schein, UBS Financial Services Private Wealth Advisor Ali McCartney, and Strategic Wealth Partners President and CEO Mark Tepper. Guys, great to be with you this morning. Thanks so much for coming on. Ali, let's go ahead and kick things off with you because there's so much to watch this morning, but my radar is tuned in to that CPI number. 7.3% would be literally a 40-year high, and this could have a huge impact on consumers, the economy overall. Your thoughts?
That's exactly what we need to be watching for this morning. So we're about to get the January CPI number. We're going to get both month over month and year over year. And this is what the market's waiting for, because if the number comes in very hot, more than expected, as you said, we're already looking at the high since 1982. Then people are going to get worried that the Fed is going to come in even more hawkish, and that's going to be really difficult for growth stocks. So we at UBS are expecting about a 0.35 month over month, which again is decelerating. So is less than the increase last month, which is what we're hoping for, to see that trend coming down. And then a number around 7 for year over year. The thing that we have to remember is there are 3 components of inflation that everybody is watching right now. One is labor, for all of the reasons we just discussed, increasing labor costs, not enough workers to get into factories and make the goods that we need. Mm-hmm. Second is energy. We're seeing energy above 90, and that's likely to continue. And that's probably contributing to about a third of these numbers. And then the third is food, which is also a very volatile component. So all eyes are on this, and I think this is going to determine the tone of certainly trading for the remainder of the week and into February.
I hear you. Robert, I want to talk about earnings a little bit as well, because investors out there are focused on Disney shares. They did jump this morning after a big first quarter earnings beat. The company reporting 11.8 million new Disney Plus subscribers, bringing the total to 129.8 million. Also this morning, we're going to see reports from Dow component Coca-Cola, just reporting that double beat, while Twitter reported a double miss. What are you watching, and what do you make of the numbers so far?
Disney certainly came out and blew away expectations. And it's great to see that it's a reopening trade, a reopening theme once again. And I think that's the broader look on earnings right now. We're looking at companies' individual earning report that are talking about the ability to pass on the inflation to the end consumer. Because as an investor, you want companies that we saw earlier this week and last week, from Amazon to Chipotle and even Procter & Gamble, they raise prices to the end consumer. So from an individual stock basis, if you are selective as you commit capital, as we do, there are some great opportunities. Now, obviously, the Federal Reserve is going to be all eyes on them. And so it's going to be a case by case, meeting by meeting for the remainder of this year for the Federal Reserve. All eyes will be on them. There's a lot for the Federal Reserve to tackle. Listen, whether the CPI report today is hot or it's not, you and I, whether it's spend money at the gas pump or at the grocery store, we don't need the government data report to tell us that there's inflation on the kitchen table.
We don't.
There's still an opportunity for the investors, if we're positioned appropriately, take advantage. But you have to pay attention to the earnings reports, and the Fed is a case-by-case basis right now moving forward on their meetings.
Yeah, and I want to drill down on that notion a little bit more, Mark, with you, with respect to certain investments that you think are a good idea right now. Consumers and investors always have to be looking at this market, thinking about how to reposition, sort of how to, navigate as we get more data, as we can figure out more of what the trends look like.
So you just used the word reposition, which is the perfect word to describe, I think, the best way to invest right now. So if you look back to 2020, 2021, that was all about finding those diamonds in the rough, those under the radar stocks with super high growth potential that could double or triple in the matter of a year. This year, it's all about just keeping the ball in the fairway. Leave your driver in your bag. I don't care if you need to bust out your 7-iron. Just keep it in the fairway. Don't get cute. Boring is back in vogue. And I think it makes sense to focus less on all that hype surrounding growth potential and more on durable growth and current cash flow. So two names I like, Raytheon and Bank of the Ozark. Raytheon, obviously one heck of a defense company, and we all know that our adversaries are getting much more aggressive in their respective regions, Russia, China. And Raytheon is a leader in missile defense, namely hypersonic missile defense, which is exactly what China was testing a few months ago. So defense stocks, I think they have a pretty good runway, at least through the 2024 presidential election. I think Raytheon's outperforming the S&P by 15% already year to date.
Yeah.
Bank of the Ozark, one of the best ways to play rising rates is through the regional banks. Unlike the big banks, which have all these diversified revenue streams, regional banks are highly dependent on making loans. So they're going to have the opportunity to raise rates on those loans, and they're not going to pay much more for deposits, so margins go up.
All right. Well, I oftentimes will leave my driver in the bag and use my 3-wood because I get more control that way. Robert, Allie, Mark, great to see you guys. Thank you so much. And Mark, of course, you'll be with us all morning. Much more ahead this